Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, Happy New Year and welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. Today, I'm really excited. We've got our group CIO, Dan Ivascyn, here on the pod with us. We're going to make this an annual tradition. We're going to kick off the new year with Dan, get his thoughts on the investment landscape for the year ahead. Dan, thanks for taking the time to join us.
Thanks, Greg. It's great to be back.
I know it's a busy kickoff to the year. I hope you had a nice holiday. I hope you got some rest. Hope you're raring to go.
Yeah, we tried to ski. Not much snow, but it was a good time to relax a little bit, get outside and digest the financial market performance last year and get ready for the new year.
That's good. Yeah, I heard about the snow conditions in Utah, right? That's the destination.
That's right.
Yeah.
It's not ideal, but still good family fun.
Good. Well, let's talk about the year ahead. And I want to start maybe just from a top-down perspective. Where do you see the macro landscape as we look forward into 2026?
Yeah, we're continuing to be pretty optimistic about the growth picture. In fact, we see growth accelerating in the first half of the year here in the United States. We've gotten some pretty good recent data on the productivity front, on the growth front in the fourth quarter, and we think that's likely to continue. On a global basis, more uncertainty across Europe, China still struggling, but generally speaking, at least thinking about the base case, we do see positive growth on the inflation side. Inflation will likely trend a bit lower towards the end of this year. Still plenty of uncertainty on the inflation front. And I think the only challenge there in terms of the base case is that this type of optimism that we have is reflected in market pricing.
Right.
Whether you're looking at equities or credit, the riskier areas of the market. So in some sense, I'm describing the market expectations here. So on the margin, we're a touch more cautious than what's implied in many valuations, but we probably are in for again a positive growth year and one where we surprised to the upside at least during the first half of the year.
Yeah, I think the last time we spoke, we talked about a little bit of anticipating a little bit of a dip in the third, fourth quarter of last year, and then a reacceleration in the front part of 2026. Can you talk about what's driving that and what makes us, whether you think it's sustainable throughout 2026, or do we see maybe another inflection point somehow mid-year? Sure.
Yeah, there are two areas that we think are going to drive better growth in the first half. One, we in the market have talked a lot about just this infrastructure investment. Most of it tech related, either directly or energy related, to drive some of the tech development that's continuing to have a quite positive impact on growth. Then the delayed impact of the Trump tax cuts or the Trump bill from last year.
Mm-hmm.
A lot of the corporate related tax cuts were put in place retroactively. On the consumer side, though, or the household side, you'll see a more direct impact now at the beginning of the year as part of the year-end tax filing process. So we do think that will provide a bit of a boost to the consumer early in the year, and then that will wane throughout the remainder of the year. So one more temporary in nature on the infrastructure spending. The base case is that this is going to continue,
mm-hmm.
But there's plenty of uncertainty, as we know, as companies continue to assess these investments. A lot's going to depend on market reaction, and things are moving so quickly, within the tech sector that this is going to be a source of continued uncertainty, but also opportunity, of course, for an active asset manager. So it's always good to have a little bit of volatility and uncertainty like we have, from a fundamental economic perspective and in a markets perspective as well.
I mean, maybe taking, kind of both segments you mentioned, right? So AI, you didn't say AI, but so I'm simplifying it, but call it AI CapEx as being sort of a pillar. and then of course the fiscal stimulus of tax cuts for households. One of the things I've heard you talk about internally a lot recently is this the notion of a K-shaped economy, and so I wanted to, well, maybe you could define that for people listening, but also the question I was going to ask is we talk about a little bit of a tax boon to households. Is that evenly distributed? Is it all households participating in this growth, or are we seeing a little bit more differentiation?
Yeah, let's talk about the K-shaped dynamic. First, here in the United States, there absolutely have been winners and losers across the economy, despite positive growth. Those upper income households that own a home, as an example, are performing particularly well. A lot of these households were able to lock in historically low mortgage rates for 30 years, while their primary asset, the house, has continued to go up in value. So, in the middle income cohort groups and above, considerable strength. Those involved in the tech sector, obviously, considerable strength. And those that have the ability to own equities have benefited from 15% type equity returns now for 15 plus years. So a very, very strong household balance sheets there. Within the lower income cohort groups, though, those that aren't fortunate enough to own a home, more signs of strain and stress. Elevated prices, inflation, difficulty owning a home, and until more recently at least, elevated and steadily rising rental costs, and beginning to see the negative impacts of tech innovation, workers being displaced, and challenges around retraining, and just struggles again within those cohort groups. Again, if you don't own a home and you didn't lock in long-term funding and you have a credit card balance, rates remain quite elevated. So we're seeing some challenge there, some deterioration there. We don't think there's enough to tip the economy into recession, but it bears watching both from a macro perspective over the next several years, because this AI innovation, although it could lead to economy-wide productivity, can create a lot of strain and stress across industries, across households, regions, and this is something that we're focusing on very, very closely. I think you can also extend the K-shaped concept even on a global basis at the sovereign level. A country like the United States is benefiting tremendously from a core group of technology companies on the cutting edge of this technological development. Other countries around the world don't have that benefit. In the United States, households locked in low mortgage rates for a 30-year period. The consumer sector isn't facing the strain from still elevated short-term interest rates. In other parts of the world that have more floating rate type consumer debt markets, you still see some strain and stress there. So even though global growth we expect to hold up reasonably well this year, there's tremendous differentiation even across countries. And you could extend that to the fiscal picture and how much fiscal space these various countries have because of elevated debt levels on a global basis. So, although we tend to talk in general terms or simplistic terms about positive global growth, positive U.S. growth, there's a tremendous amount of differentiation. And again, that's great for active asset management. It reminds us a lot of that period in the mid-'90s, early 2000s, much less policy, volatility suppression, a lot of less synchronized economic cycles, policy cycles. And again, that typically is a good environment to generate incremental return and above and beyond, what are pretty attractive bond yields still.
I mean, I guess the way you just described it, I hadn't thought about it that way, but we've got household haves and have-nots, and obviously don't make light of any households that are struggling economically, but it's an economic reality in the country. We've got corporate haves and have-nots, and we have sovereign haves and have-nots. I'm curious, against that backdrop, how do you handicap Fed movements in 2020? If we can shift to the Fed a little bit, because that's sort of the next, or at least one of the that we know of, one of the next big things to occur in this year is, of course, a new chairman being selected. So how are you putting your Fed, crystal ball into place and thinking about how they're going to react to all the the inputs you just described?
Sure. Well, the Fed has told us they're going to be focusing on the data. Even when they don't tell us that, that's what the Fed tends to do. So the data is going to matter. And that there's still significant uncertainty both on the growth and the inflation front. So I think that's the most important point is that there's a decent amount of policy uncertainty out there at this point. With that said, we do believe this is a dovishly inclined Fed. It's likely to remain dovishly inclined with the new chair. And we do believe that they would like to get rates lower. So our base case thinking is that there'll be enough economic weakness in the base case for the Fed to get rates down towards 3% or even 3% in terms of the base case. If the data remains strong, if we see any form of meaningful growth reacceleration or an uptick in inflation, this is a Fed that's going to be on hold. We do think the bar is quite high to take rates up from here, but we do think this is a Fed, if they do see some concerning signs around reaccelerating inflation, or if the economy continues to remain quite strong, like some of the more recent prints that we've seen, they're happy, staying on hold here. So that's the general thinking. The dovish inclination is something that is certainly supporting risk assets, but again, we're going to have to wait and monitor this data over the course of the next few months. We are not at this point in time, here at PIMCO, placing big bets or big positioning on the central bank doing more than what's currently priced into the curve. We have a much more balanced view. It's been very, very target rich to trade market pricing versus the Fed the last few years. But for the time being, we're back in more of a neutral position. We think that the markets are getting it close to right in terms of their expectation for where rates go from here.
And so when I think Governor Myron mentioned 100 basis points of front-end easing, and I think Secretary Bessent was out even just today in his prepared remarks saying that the Fed ought not to delay. I'm sure we factor those into our analysis, but for the time being, you're not making outsized moves based on some of that job owning.
Well, that's correct, and policymakers like lower rates. We do believe that the Treasury and the Fed would like to get rates lower, but of course, markets need to cooperate. Lower front-end rates don't necessarily mean lower intermediate or longer maturity rates. In fact, even as we've seen the federal funds rate come down over the course of the last year or so, as we know, longer maturity interest rates are right about where they were, actually a little bit higher than where they were at the start of last year. So people don't want, or policymakers don't want, longer maturity yields to go meaningfully higher. So they will be assessing policy based on not only the incoming data, but the market reaction to that data as well. And that's why, again, given our view that growth will reaccelerate, that inflation is going to remain above target, that you still have some uncertainty around tariffs that have been put in place, and there's a lot of uncertainty even about whether those tariffs stay in what form they take. We think that betting on 100 basis points of cuts right now is a bit excessive, at least in terms of base case thinking.
Right. And that's interesting. The tariff, I suppose in our growth forecast, there's some thought about those tariffs either being withdrawn or reduced, or depending on what the Supreme Court decision ultimately comes out in later on in this year. But that could be maybe another accelerant to growth mid-year, and obviously would have an influence on the rate dynamic and certainly the revenue and the fiscal dynamic for the U.S. government.
That's right. And we think there's a decent chance you get at least a partial reversal,
right.
Which means that this is going to continue to be an ongoing source of uncertainty for markets. It could lead to some short-term movement in risk markets as well as bond markets. But again,
let me finish the sentence for you, Dan. That'll make it a great environment for active investing.
Yeah, I think so. A lot of movement and uncertainty like this, gives you the opportunity to make or lose some money. So yes, it's good to see this uncertainty out there. We just got to get our positioning right.
Yeah. Well, I want to talk about, let's maybe if we can sort of switch to the practitioner side of this and talk about, positioning and the investment outlook, which, I think you referenced really early in this conversation, right? You have the macro foundation, but then of course there's what the market's already priced in and where expectations are, where valuations are. So, I think it's really interesting when we talk about some of the haves and have-nots, how our investment views might kind of diverge a little bit just based on prices. Maybe in thinking about the investment outlook, we can cast our minds backward a little bit and just I'd love for you to talk about 2025. It was a phenomenal year for a lot of asset classes. It was a great year for bonds, I think, generally. And then the alpha opportunities, you yourself and our team managing active strategies that did significantly better than the aggregate indices, and I think we're quite pleased with the ability to source excess return in last year's market. Maybe you could walk us through some of the things that worked, some of the things that didn't, and some of the themes that you think may carry over or may not carry over into 2026.
Sure. So let me start with the fact that at the beginning of the year, yields were attractive. After several years of very, very poor bond market performance, yields got to a point where they looked quite attractive on a standalone basis, quite attractive versus equities, and quite attractive versus cash. So we had really, really good initial conditions from a value perspective, which still exists to a significant degree today. You mentioned the aggregate index. We run a lot of portfolios versus that Bloomberg aggregate index. It had a yield, up around 5%. Early last year, it still has a yield of, around 4.5% today. And it's not a very exciting index. It doesn't have global exposure. It doesn't have a lot of asset-backed exposure. It doesn't capture a lot of other real interesting high-quality opportunities. But again, still offers a reasonably attractive yield in a historical context. Then throughout the year, you really got paid to take advantage of a very broad and global opportunity set. Non-U.S. bonds and stocks outperformed U.S. ones. The dollar weakened throughout the year. You had lots of opportunities to generate incremental return by diversifying into other areas of the market. Higher quality emerging markets did very, very well. Various forms of non-dollar exposure, even sized in small percentages across portfolios, performed real well. And a tremendous amount of opportunity to actively trade these markets throughout the year. Again, it reminds me of, back in the late 90s, early 2000s period where there've been a lot of very attractive and incremental forms of return. Then also the ability to concentrate our positioning in certain maturity buckets mattered a lot last year. We refer to it as a steepener trade, but what that typically means is targeting shorter maturities. In our case, approximately buying 5-year type instruments and significantly underweighting the long end of the yield curve. This is an important point because we hear a lot of investors say, well, gosh, the market's rallied. We may have missed our opportunity to lock in returns in fixed income. That's partially true. The market did rally. Shorter maturity yields have gone down quite a bit. 10-year yields have gone down quite a bit. But those longer maturities that we were underweight haven't gone down at all. And across many markets have actually gone up, creating what may very well be an opportunity in 2026 to extend some of those maturities in areas that are now offering yields, well above the Bloomberg aggregate index. In government bond markets, high quality markets like ours, almost 5% type yields. And if you do venture into other high quality markets outside the United States, even without taking currency exposure, you can quickly get up to 6%, even 7% type yields. So just one example of an opportunity that's presented itself because of the big moves across different maturities that we witnessed. And then looking into 2026, to some degree, it's going to be more of the same. Take advantage of a global opportunity set. Stay liquid. What liquidity offers you is investment flexibility. It gives you the ability to react to this shifting global environment. to earn more than the starting yield. And again, that's been a very, very powerful source of return the last couple of years for us. We think that's going to continue. And what it again allows you to do is to be able to generate very, very strong returns in the fixed income markets without opening yourself up to a lot of economic sensitivity. I'm sure we'll talk more about credit, but what's really, really great is you don't have to take that aggressive, lower quality credit risk today to generate attractive returns in this market. And we think that this trend is going to continue again, well into 2026 and beyond.
No, it was interesting as you were walking through, some of the sources of alpha or excess return, last year. Credit, we didn't mention that, right? Or at least corporate credit. And I thought that was an interesting. Omission, right? Given your own views, as we've talked about a number of times on the podcast, you've for a long time now you've found corporate credit just to be, in my words, not yours necessarily, but just sort of uninteresting, relative to other things that you've got in the portfolio. Is that theme carrying into 2026 as well? Has there been any reevaluation of that?
It is. Now, when you have a positive view on growth, when you have a positive view on the tech sector, credit's probably going to perform well in the base case. But again, as active asset managers with a global footprint and tremendous flexibility across most of our mandates, we can buy investments that will perform well when credit's performing well, but that will provide meaningful downside protection if you do get into a slowing economic environment. Credit's done very, very well. There's a decent amount of complacency in this market. Underwriting quality continues to deteriorate. So again, we're not screaming from the rooftops like we were in the mid-2000s, that this excess has to unwind in a highly disruptive manner. We just find it less interesting. And, we view our job as allocators on behalf of our partners and shareholders across these strategies is to try to generate return even in a risk-on environment with more resiliency than you can currently find within the corporate credit markets. And then again, we have some more significant concerns in some of the areas that have grown too rapidly. Some of the areas where you're talking about lending to more levered, lower quality borrowers. There is an area where we've been more defensive. And we do think that this dynamic continues. Now, again, if this is another positive growth year, another year where stocks go up, mid-teens, or provide mid-teens type returns, credit will do well. But we're also confident that our strategies can perform well or even exceed the return of more credit-sensitive strategies, given the significant relative value advantage that we see in some of these other areas of the market.
Yeah, just a risk that you don't need or want to take to get to a result that you think is as good or even superior. I think we talked about the haves and have-nots earlier in the discussion, and I wanted to ask you, and this is kind of fresh off the press, so I have no idea what you'll say here, but I thought it was interesting, on the one hand, reading headlines this morning about record issuance in bond markets. Now, some of that's sovereign, but a lot of it's corporate credit, where $260 billion, I think, week to date, right, to kick off the year, as of the Bloomberg headline this morning. By the same token, and you alluded to this, but also seeing some of the private credit guys, especially in the wealth market, and the advisors listening to us will be familiar with this, starting to kind of scrape up against their redemption limits in some of their vehicles, and obviously seeing flows begin to slow down into that space. You've been asked, and I've been asked about the cockroach phenomenon and the implications of that for private credit. But it was interesting to me to sort of see that large issuance number, but then also to maybe see a reduction in confidence at the investor level in some of the private credit stuff. And it strikes me like that could be that disconnect could be something we see sort of hit a little bit of a reckoning point in 2026. I don't know if you've got thoughts on that.
Yeah, a few thoughts. And, I mentioned we're operating from a more defensive position in terms of our overall corporate credit allocation. But we also see significant funding needs. And we're seeing a pipeline of deals, even some deals that weren't able to get done late last year out there in the marketplace. So, from more of a positive perspective, there are certain pockets within the market where you can drive terms, get the type of protections that you want, get good pricing in size. So from a special situations perspective, a lot of exciting things that we did last year and we expect to continue to do. So there are going to be some real attractive opportunities to source on behalf of our investors. But to your point, around uncertainty, these are well-integrated markets. You don't have some private market, isolated from public markets. Issuers understand this, and they regularly test different alternatives on what market they can issue into. These are reasonably substitutable across more flexible asset managers. So when you have challenges in one sector, there are typically challenges in other segments of the credit market. And you touch on a dynamic that bears watching, and that is that when you look at publicly traded vehicles that hold a lot of private credit or private real estate, debt or equity, they've weakened more recently. And there's a practical limit to how great a gap can be within the tradable segments of the market and the non-tradable segments of the market. Because when you see that gap widen, the most obvious trade to do is to sell the positions that are marked meaningfully higher than where those are trading in the public markets. And you've seen that dynamic on a more isolated basis. But this is a concern, and this will likely be a catalyst to more significant credit widening. If that gap grows, it'll likely grow at a point in time where people are getting a bit more nervous about economic growth more broadly. But you also have another dynamic that is actually mentioned a lot less, and this relates to this AI-related innovation, an increase in productivity. There's a tendency to think, well, okay, when growth's strong, credit does well, and that's true in a macro sense. But if growth is being fueled by highly disruptive new technologies, what may work for the economy as a whole can be quite detrimental for certain segments of the older economy. And I think some of the strain and stress you've seen in the direct lending space, even in the senior secured loan space, is associated with these early stages of technological disruption. So I think this is going to be a theme over the next few years, that even though if the economy remains strong and stocks keep going up, credit in general can continue to perform, there are going to be more losses. And if you are in those segments of the market where the losses are elevated, your experience may be very, very different than the market as a whole. Again, representing the need to be defensive, cautious, targeted in terms of your overall underwriting. So again, there's going to be a lot of exciting things to do, but they're going to be elevated losses than what people have grown accustomed to, at least during most of the years coming out of the global financial crisis.
Yeah, this theme of the haves and the have-nots, and the comment you made earlier, just that the beauty of liquidity is the ability to change your mind, and from what you're laying out, I suspect, and I mean this, in the best possible way. Like I suspect, Dan, that you'll probably change your mind a number of times this year based on the data and the metrics that come in. It's shaping up, it seems like, to be a year where you have to be really, really focused on the fundamentals and the micro to make sure that you're getting the macro right.
Absolutely, and this has been a theme in the market the last few years. Yeah. People, there tends to be, and a lot of times this comes from people that have more of a private credit background, a focus or even a fixation on starting yield, as if, well, that's the most you can get unless there are losses that eat away at that yield. But in markets where you have this type of flexibility, you have the ability to change your mind even just a little bit along the way. So typically your starting yield is a floor on what you'll earn if you own flexible and public fixed income, over a 3 to 5 year period. And if you make a few thoughtful asset allocation decisions along the way, you can stay in the higher quality area of the market, and you can add incremental return above and beyond what are still attractive yields. If you look at the performance last year across a lot of our strategies and other strategies out there that have these characteristics, that's precisely what happened. And by shifting again, perhaps from those 5 year maturities that did so well last year, into longer maturities that didn't do as well, that's the next tool in the toolkit, or a tool in the toolkit to generate incremental return above what are still pretty good starting yields. And again, we didn't talk about this yet. I think a lot of the listeners are probably in cash right now. We get it. 2022 is an experience that I'm personally still recovering from in terms of, well, you hear me say this, or volatility. People discovered the wonders of non-mark-to-market accounting during 2022 because almost everything went down other than the private stuff. But the point there is that cash rates are probably going lower. The Fed wants to get them lower. We think they get down to at least 3%, but the cost of holding cash has steadily gone up the last year or two, while yields have remained quite attractive in longer maturities. So I think investors are going to be beginning to feel that cost in terms of the yield give that exists today, but which is likely going to further erode over the course of the next few months. So even from a defensive perspective, the idea of extending out the curve a little bit, extending into a longer maturity fund, and you don't have to go all the way out to 30 years, likely makes a lot of sense from a strategic perspective as well.
It's a really important point, I think, that we try to make in all our conversations with advisors, that the cost of suppressing volatility in your clients' portfolios can be really high. If you're doing that by maintaining an excess cash balance, you're potentially not taking advantage of really excellent risk-adjusted return that's available to you in other parts of the market. If you're doing that by staying in private product that marks to a model, and the market is telling you that similar products, as you said, Dan, similar exposures that are marked to market are at a 10-15% discount on average, by definition, you're costing your clients additional return that would be available if you made the switch. And I think that'll hopefully that's a theme that we can talk about more on the pod this year, and a little bit more of a return to that 90s environment that you mentioned, where volatility was more friend than foe, and something to be taken advantage of, not something to be necessarily afraid of. Do you mind if you mentioned tools in the toolkit, and I did want to, this has been a global week. We're recording this on Thursday, January 8th, and of course we had the news on Venezuela this past weekend. There is a lot of talk about Greenland in the news these days, and the global toolkit's been so important to you over the last few years. I'm curious if you could just give our advisors a quick rundown of some of the opportunities you're seeing around the world, and why they exist, and what you think is most interesting.
Sure. So we talked earlier about still attractive interest rates here in this country, but the United States is somewhat unique in that we're running quite elevated deficits, which means we have to issue a lot more debt, and our economy is reasonably strong, meaning that we probably have rates that remain elevated for a more extended period of time. So both some fiscal concerns or fiscal deterioration at a time where growth and inflation remain high and strong, or strong and high. Outside the United States, though, there are many countries with a very, very solid fiscal picture, with yields higher than the United States, with economies in some cases that are a bit more fragile. So you can actually pick up yield, pick up credit quality, pick up diversification by simply selling a few U.S. bonds and buying other high-quality alternatives around the globe. Australia is a good example. Mm-hmm. The U.K., which has the challenges associated with a smaller open economy and their own currency, but they too offer quite attractive yields versus the United States. And by owning some of them, you can pick up not only incremental return, but reduce overall portfolio volatility. Higher quality emerging markets, well ahead of the curve on managing inflation coming out of the COVID period, offer very, very high real interest rates relative to the United States. Again, an area that helped generate some returns last year, an area that still looks quite attractive. You can hedge that back to the U.S. dollar to reduce volatility or take a little bit of currency risk. The dollar weakened, quite significantly during the first half of last year, we expect over the course of the next few years the dollar weakening trend to continue. It'll be bumpy. We don't have a tremendous amount of non-dollar exposure across most of our portfolios, but a great source of diversification. So, at the end of the day, a little bit of currency exposure, a little bit of exposure to global rate markets has this wonderful combination of giving you higher returns, lower risk, more diversification, less portfolio volatility, which again is a situation we didn't have for many years. For the longest of times, you looked at yields on a global basis. They were low. You subtracted inflation, you ended up with a negative number. In some parts of the world, you started with a negative number. Things have changed a lot, and we do think over the course of the next year or two, the global investment community is going to begin to appreciate that more, and that can be a catalyst for not only yield generation, but very, very strong continued price performance as well. You pick up your Bloomberg, and all you hear about is private credit, primarily U.S. private credit. Very little talk about emerging markets, very little talk about global bond investing, because lots of people walked away from those markets when there was no value. And this tends to be a real good setup when you go from very, very rich valuations to cheap valuations, and then you get the wave of money coming a bit late, but moving into areas that have been underowned for many, many years. And of course, that money typically comes out of areas of the market that were overowned or overallocated to. So we haven't seen that wave yet, but this also is an example of the positive optionality you have by shifting into a global opportunity set, because at some point it will come. And that's when you can take, attractive returns and end up with, really strong relative performance. We had a flavor of that last year, but we do expect more of that dynamic. When it happens, we don't know for sure, but it's an exciting time for investors now, because we do think that dynamic exists and creates the potential for even more incremental return than we talk about in the base case.
Yeah, I think it's interesting. The advisors that we speak to, or we ourselves, sitting in the U.S., often have a bit of a home bias, and it makes sense, right? We spend money on things in dollars for the most part living here in the United States. So there's always a little bit of I think for us when we talk about international markets, you've got to kind of get over that bias. I'd note it's been interesting to us watching over the last year or so some of the institutional pockets of capital in the U.S. and certainly some of the platforms where advisors work have been allocating discretionary portfolios a little more globally, and they often are a little bit of a leading indicator to your point that maybe some money will follow that later in the year. So that's a really interesting dynamic. Well, Dan, I want to let you get back to markets, because it does sound like you're going to be pretty busy in 2026. But thanks for taking the time out of the gates with us to sort of set things up. Any closing comments you want to offer to the folks listening?
Always thanks. We appreciate all the support of the listeners to the podcast and investors in our products. It's great to be able to spend some time with you and kick the year off and talk about some trends and themes, but we only scratched the surface. So, want to be available, make the team available to have more micro direct discussions with folks in areas of particular interest. So, although we're kicking things off, we want to make sure that we communicate well. We listen to feedback and try to take some of these more formal discussions, down, to the individual level or the group level, and continue the dialogue. But again, it's been great to kick off the year in this way, and I'm already looking forward to next year's version.
Yeah. Well, no, we're going to get you back mid-year, Dan. Don't. All
right.
Don't. We got you in June. I think it's already on the books, and that's going to be our pattern going forward. Hey, that's a perfect segue. If anything on the pod today interested you and you'd like to follow up or learn more, visit us at PIMCO.com or the PIMCO website in your home country. If you identify yourself as a financial advisor here in the U.S., you'll be taken to Advisor Forum, which is our one-stop destination for you to get what you need practically and efficiently, and to go deeper on all of these issues. We'll be back in a couple of weeks with another episode. Want to wish all of you the very happiest of New Year's and great success and good fortune in 2026. Thanks so much.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures